This is not financial advice, educational content only. A company announces a 1-for-10 reverse stock split. The press release calls it an effort to enhance the trading characteristics of our common stock. The stock moves up on the day. Then the next 10-Q lands, and there's a going concern note from the auditors on page 4. The reverse split wasn't a cleanup, it was a runway extension, a way to stay listed long enough to raise more dilutive equity capital. The signal was sitting in the filing chain the whole time, not in the announcement. Reverse stock splits are one of those corporate actions that look purely mechanical on the surface. A fraction applied to share count and price. But the footnotes tell a different story depending on the company. Today we're going to read them. Before we get into what to look for, let me walk through where these actions show up in the public record because the filing sequence matters. When a company executes a reverse stock split, it files a Form 8-K, typically under Item 503, amendments to articles of incorporation or bylaws, or sometimes under Item 8.01, other events, depending on whether the mechanics required a charter amendment. That 8-K discloses the split ratio, the effective date, and the adjusted share count. It's usually short before the 8-K if shareholder approval was required, which is the case unless the board has been authorized to execute a split under the existing charter. You'll see a proxy statement, 42A, filed with the SEC and searchable on EDJAR. The proxy typically runs longer than the press release and includes the board's stated rationale in detail. Pay attention to how the board authorization is framed in the proxy. Sometimes the resolution authorizes a specific ratio 1-for-10, sometimes it authorizes a range of 1-for-5 to 1-for-20. At the board's discretion, a wide authorized range is its own data point. It usually means management is uncertain exactly how far the stock needs to move to cure a compliance deficiency, and they're hedging their own uncertainty about where the price will be by the time they pull the trigger. Press releases for reverse splits cluster around 3 explanations, and only one of them carries real diagnostic weight on its own. The first, to regain compliance with NASDAQ minimum bid price requirements. NASDAQ Rule 5552 requires a minimum 1.0 closing bid price for continued listing on the NASDAQ capital market. NYSE and NASDAQ Global Select have their own equivalent thresholds. A company whose stock has drifted below that level receives written notice and typically has 180 days to cure the deficiency. The NASDAQ staff determination letter is sometimes disclosed in an 8-K when it arrives. A reverse split is the mechanical solution. This framing is the most honest, and it tells you the company knows exactly why it's doing this. The second, to enhance the trading characteristics of our common stock. A phrase that means almost nothing without the numbers behind it. It's the framing used both by companies doing genuine long overdue cleanup and companies whose backs are against the wall. The third, to support our uplisting to a major exchange. For companies moving from OTC markets to NASDAQ or NYSE, minimum share price is a real structural gating requirement. In isolation, this is neutral to positive context. Read it together with the financials before drawing conclusions. None of these headline framings tell you which category the company is actually in. That's what the numbers are for. Here are the 4 numbers I look at in the amended articles of incorporation or the 8-K exhibit when a reverse split is announced. First, authorized share count after the split. This is the most consequential number and the most commonly overlooked. A company that does a 1-for-10 reverse split and leaves authorized shares at, say, but now has only 15 million shares outstanding post-split, has just created an authorized but unissued reservoir of roughly 485 million shares. That capacity can be deployed through registered direct offerings, at the market programs, or equity line facilities at any time the company chooses. The reverse split mechanically did not dilute anyone on the record date, but the structural capacity for future dilution is now orders of magnitude larger relative to the float. Whether management intends to use that capacity is the question. That's my read. Second warrant and option table. Anti-dilution provisions in warrant agreements require proportional adjustment when a reverse split occurs. The exercise price multiplies by the split ratio, and the share count divides by it. Check the 10Q footnote tables, specifically the derivative liability or warrant disclosure schedule for the adjusted exercise prices. If material warrant positions remain exercisable at prices below current market post-split, that overhang is still there. Third, convertible note terms. If convertible notes are outstanding, check the indenture for reset or ratchet provisions. Some convert at a fixed discount to market. Some contain full ratchet anti-dilution clauses that entitle note holders to additional shares if the stock price falls below the original conversion price. A reverse split that temporarily lifts the share price does not extinguish a ratchet provision. That's my read. Fourth, and minor the gap between effective date and record date. A gap longer than a few business days sometimes reflects complications with the transfer agent or DTC clearing mechanics. Minor flag on its own, worth noting in context. The most diagnostic signal isn't in the 8K at all. It's in the 10Q filed in the same fiscal quarter. ASC 4, the going concern standard under U.S. GAAP, requires management to evaluate at each reporting period whether substantial doubt exists about the company's ability to continue as a going concern within 12 months of the financial statement issuance date. When that doubt exists and management cannot demonstrate that its plans will sufficiently alleviate it, the auditor includes going concern language in their review report. That language is standardized. You'll find it in the Independent Accountant's Report section of the 10Q, typically reading something like, "Substantial doubt exists about the company's ability to continue as a going concern." When that disclosure appears in the same quarter as a reverse split announcement, the reverse split is almost certainly a compliance preservation move, keeping the stock listed to maintain access to the equity market for future dilutive capital raises. The split buys runway. It does not fix the cash problem. I want to be precise here. A going concern opinion is not a bankruptcy prediction. Companies receive going concern language and subsequently raise capital, refinance debt, reduce burn, and survive. The disclosure is a flag triggered by defined accounting criteria, not a verdict. But the compound signal, going concern plus reverse split plus large authorized, but unissued share count, is a different reading than any one of those items in isolation. That's my read. The contrast is a company with positive operating cash flow, a leverage ratio within covenants, no going concern language, and a share count bloated from years of equity compensation grants at low strike prices. Many fund mandates prohibit purchasing securities priced below $5 or $10 per share. A reverse split in that context may genuinely be about broadening the institutional buyer base. Same corporate action, structurally different story. The 10Q tells you which one you're looking at. Here is where this methodology scales beyond any single filing. Reverse splits cluster by sector and by credit cycle. During 2020 and 2021, extraordinary equity issuance volume (SPES) at the market program's PIPE transactions registered directs flowed into particular sectors: early-stage biotechs, pre-revenue EV adjacent companies, software businesses with capital-intensive growth models. Many of these companies issued large share counts at low per-share prices to preserve cash during an uncertain environment. When the rate environment shifted in 2022 and equity valuations compressed, the same companies saw per-share prices fall further. Minimum bid compliance deficiencies concentrated in those sectors. Reverse split activity in biotech and SPEC survivors was visible across 2022 and into 2023. I'd characterize it as concentrated rather than isolated, though I'm hedging on exact numbers here. When you observe a cluster of reverse splits across a sector over a compressed time frame, that's not a collection of idiosyncratic company stories. It's a structural signal about the funding environment. That's my read. The question worth asking is how many companies in this sector can access new equity capital at terms that don't structurally disadvantage existing shareholders. Widespread reverse split activity is one symptom of that funding stress. I'm not naming tickers here. This is pattern analysis on filing mechanics, not a directional recommendation on any company or sector. All of the filings I'm describing are publicly available on EDGAR. Here's the practical tool. Next time you see a reverse split announced, pull 3 documents from EDGR. The 8K for the split mechanics and the post-split authorized share count, the most recent 10Q for going concern language and operating cash flow, and the most recent proxy for the authorized ratio range and insider option tables. Those 3 documents, read together in about 20 minutes, tell you whether you're looking at a capital structure cleanup or a runway extension with a press release attached. I'm Diane, back next briefing.